The U.S. Treasury market is now 6 times larger than it was before the 2008 financial crisis, over $28 trillion in publicly held debt, with nearly $1 trillion traded every day. Is there a point when the world can no longer absorb all the U.S. debt being offered? In this video, we'll explore what Warren Buffett and legendary central banker Paul Volcker have said about this crucial question and what it means for investors and the global economy. On March 25, 2024, the Wall Street Journal reported that the Treasury market has ballooned to unprecedented size. Randy Jeffs from Irvine, California, asked Warren Buffett directly, "Do you think that at some point in time the world market will no longer be able to absorb all of the U.S. debt being offered?" Buffett's answer and the lessons from Paul Volcker's fight against inflation provide a roadmap for understanding the real risks and the hard choices ahead. The U.S. Treasury market is the bedrock of global finance. With $28.9 trillion in publicly held debt and an average of $910 billion in Treasury securities traded daily, it underpins both domestic and global markets. Treasuries are considered among the safest and most liquid investments, thanks to the full faith and credit of the U.S. government. Nearly 1/3 of this debt is held by foreign investors, with Japan, China, and the United Kingdom as the top holders. But the market's explosive growth, now 6 times larger than before the 2008 crisis, raises critical questions. Can the world continue to absorb U.S. debt at this pace? Or will rising deficits, political instability, and global economic shifts eventually erode confidence? Warren Buffett's answer to Randy Jeffs' question is both candid and cautious. I would say, and the answer is of course I don't know, but my best speculation is that U.S. debt will be acceptable, but for a very long time because there's not much alternative. Buffett acknowledges that the sheer quantity of debt is less important than the risk of inflation spiraling out of control. He points out that for much of history, the national debt was nothing to speak of, but now it won't be the quantity, it'll be whether in any way inflation would get let loose in a way that really threatened the whole world economic situation. Buffett emphasizes that the dollar remains the world's reserve currency, and despite much talk of alternatives, there is no credible substitute. Buffett also highlights the importance of focusing on the fiscal deficit, not just the Fed's actions. He notes that Fed Chair Jay Powell is a very, very wise man, but he doesn't control fiscal policy. Powell has repeatedly warned that the U.S. fiscal path is unsustainable, but the responsibility for fixing it lies with Congress. Buffett recalls Paul Volcker, the legendary Federal Reserve chairman who took office in 1979. Volcker faced threats to his life as he raised interest rates to unprecedented levels, determined to break the back of inflation. He was gutty as could be, Buffett says, and if you haven't read a book or two about him, you really ought to take a look at it. Volcker's shock therapy, raising the federal funds rate to 20%, triggered 2 recessions and sent unemployment soaring, but it ultimately restored confidence in the dollar and tamed inflation. The real threat then, as Buffett notes, was not the quantity of debt, but the risk that inflation would undermine the value of the dollar and destabilize the global economy. Volcker's legacy is a reminder that central bankers can act decisively to protect the financial system, but the ultimate responsibility for fiscal sustainability lies with elected officials. The real danger is not just the size of the debt, but the risk of inflation and loss of confidence. As the U.S. debt to GDP ratio approaches historic highs, interest payments are now the fastest growing federal expense, crowding out spending on other priorities. Persistent deficits can reduce real incomes, hinder job creation, and curb productivity by crowding out private investment. The IMF and other institutions warn that rising debt levels could lead to higher borrowing costs, reduced confidence, and slower economic growth, not just in the U.S., but globally. If investors begin to doubt the U.S. government's ability to manage its finances, they may demand higher yields, pushing up interest rates and making the debt even harder to manage. Despite these risks, the dollar remains central to the global economy. The search for alternatives such as the euro, yen, or digital currencies has so far failed to produce a credible challenger. The dollar's dominance is reinforced by the size and liquidity of the Treasury market and the fact that most global trade and finance is still conducted in dollars. However, the U.S. cannot take this status for granted. As Buffett and Volcker both understood, maintaining confidence in the dollar and the U.S. fiscal system requires responsible policy and a commitment to price stability. The stakes are high. If the U.S. fails to address its fiscal imbalance, the consequences could be severe, not just for Americans, but for the global economy. Rising interest rates, reduced investment, and slower growth could undermine living standards and increase the risk of financial crisis. If you found this analysis helpful, let us know in the comments what you think about the sustainability of U.S. debt. Don't forget to subscribe and hit the notification bell for more insights into markets, economics, and the forces shaping your financial future.